Hello traders, welcome back to the channel. In this video, we'll quickly review last week's market performance, analyze the Nifty outlook for next week, discuss key technical support and resistance levels, and examine the latest option chain and FII data to understand what the market may be signaling. Let's begin with a quick recap of last week's market action. Nifty 50 snapped its 2-week winning streak, falling 204 points, or 0.83%, to close at 24,366, giving up the crucial 24,500 level. The key pressure came from rising crude oil prices amid Middle East geopolitical tensions, along with continued foreign institutional selling. Midweek gains triggered by cooler-than-expected US CPI data couldn't sustain the momentum. Sector-wise, the market remained highly divergent. Pharma, led by Dr. Reddy's, telecom with Bharti Airtel, and defense with Bell showed relative strength. However, broader selling in financials, consumer discretionary, and parts of healthcare kept the overall market under pressure. So, after 2 weeks of gains, Nifty ended the week on a cautious note. Now, let's look at the 3 key factors that could drive Nifty this week. First, geopolitical tensions and crude oil. Rising risks around the Strait of Hormuz are keeping crude oil prices volatile. Any further supply disruption could hurt market sentiment, while diplomatic de-escalation could trigger a strong positive reaction. Second, foreign institutional activity. Foreign institutional flows and the derivatives positioning will remain important. A shift from sustained cash selling toward consistent buying could help Nifty regain upward momentum. And finally, macro data and global cues. Markets will track the PMI numbers along with global central bank commentary for clues on interest rate cuts and global demand. So, keep a close eye on these 3 factors, as they could play a crucial role in determining Nifty's next big move this week. On the weekly chart, Nifty is trading near a critical breakout zone within an ascending triangle pattern. One interesting observation from the recent sessions is that Nifty has been attempting to open with a gap up almost every day. However, these gaps are consistently being sold into during the session. At the same time, the newly introduced closing auction session has once again pushed the closing price higher, creating an interesting gap between intraday price action and the final closing price. The immediate resistance zone is between 24,400 and 24,450. A strong weekly close above this zone could confirm the breakout and open the path toward 24,600, followed by 24,800 to 24,900. On the downside, immediate support is placed between 24,150 and 24,050. If this zone breaks, the next important support comes around 23,900 to 23,700, which also aligns with the rising trend line. Overall, the weekly structure remains constructive, but the repeated gap-up selling needs to be watched closely. A sustained breakout could lead to further upside, while rejection from resistance may trigger a pullback. Now, let's move to the option chain analysis for the 18th August 2026 expiry. On the resistance side, 24,500 remains the immediate hurdle, with around 1.73 lakh call contracts, making it an important psychological and technical level. Above this, 24,800 and 25,000 are the major resistance zones. The highest call open interest is concentrated at 25,000, with around 1.78 lakh contracts, while 24,800 has strong call writing of around 1.59 lakh contracts. On the support side, 24,300 is the immediate support, with around 1.57 lakh put contracts and fresh addition of more than 37,000 contracts. Below that, 24,000 remains the primary support, holding the highest put open interest in the chain at around 1.75 lakh contracts. So, for this expiry, 24,300 to 24,500 becomes the immediate battleground, while 24,000 and 25,000 remain the key levels to watch. Now, let's look at the participant-wise open interest data to understand how different market participants are positioned. Starting with retail traders, the positioning remains aggressively bullish. Retail participants hold around 1.56 lakh net long positions in index futures, along with heavy put writing of nearly 6.08 lakh contracts. FIIs, on the other hand, remain net short in index futures by around 1.77 lakh contracts. They're also holding nearly 4.97 lakh long positions in index puts. At the same time, their stock futures remain strongly long at around 6.24 lakh contracts, suggesting that their index positions are being heavily hedged against downside risk. Finally, proprietary desks are holding around 1.37 lakh net positive call positions, along with strong stock futures positions of nearly 4.36 lakh contracts. Overall, their positioning appears balanced to mildly bullish. So, retail remains aggressively bullish, FIIs remain cautious and hedged, while proprietary desks maintain a mildly bullish stance. This video is for educational purposes only and should not be considered investment or trading advice. Please do your own research or consult your financial advisor before making any investment decisions.